Hello and welcome to Cost Accounting. I am your host, Dr. B, and today we're going to talk about cost volume profit analysis, also known as CVP. The first thing I'd like to cover is how to calculate the contribution margin and the break-even sales point. Understanding break-even is very critical to any business because we need to know how many units to manufacture and sell in order to cover all of our expenses or to break even. One of the first points we can discuss is called the SNAP calculation. This is given the current cost structure, what do we need to sell in order to break even? How much more would I need to sell in order to earn a target profit? And how much more should I sell to make enough to save and eventually retire? These are the kinds of questions we would ask ourselves. So understanding the point of break even, we must first calculate that break even point. We do this to achieve enough sales in order to cover all of our costs without a single penny left over. In other words, revenue equals expenses, which should ultimately equal zero. It can be expressed in either a unit of sales or in sales dollars. The cost behavior part of contribution margin helps us to separate fixed and variable costs from the mixed costs, and this enables us to examine their particular patterns or behaviors. Ultimately, understanding the cost behavior and cost volume profit analysis helps management to make decisions. First, let's explore the concept of contribution margin. The contribution margin is revenue minus variable costs. Contribution margin on a per unit basis is where we take the sales price per unit minus the variable cost per unit. Understanding contribution margin, of course, helps us to identify the margin, similar to profit, generated on a per unit basis. But of course, that margin also needs to cover fixed costs, ultimately. Here we have an example to discover contribution margin per unit. The company sells pencils for 50 cents for one package. The variable cost to make those pencils is 15 cents per package. So we need to find the contribution margin on a per unit basis. To find the per unit basis, we take the sales price of 50 cents minus the variable cost of 15. This gives us a contribution margin per unit of 35 cents. We can also discover the contribution margin based off of an income statement. As you know, the income statement consists of revenue and expenses. We take the revenue minus the variable costs in order to reach the contribution margin. So variable costs versus fixed costs is important to understand in this nature. The traditional generally accepted accounting principle income statement arranges costs according to their function, product costs, and period costs. So in looking at this, sales minus cost of goods sold equals gross margin minus selling and administrative expenses equals operating income. We can break this down further to identify the contribution margin. Sales minus variable costs equals the contribution margin less fixed costs equals the operating income. The contribution margin within decision making, of course, contribution margin helps management to make decisions based off of the level of units that should be produced and sold. Some of these decisions, contribution margin, since it's swiftly managed. Changes to the fixed costs can be very, very difficult. So that's why oftentimes the decisions are made in the short run. In understanding break even, we look at it both from a perspective of number of units and sales dollars. When we look at it in terms of number of units, we take the total fixed costs and divide that by the contribution margin per unit. This tells us the level of sales needed to be achieved in order to break even in terms of units. We also need to understand what's called the fixed cost hurdle. This tells us how many units of contribution margin are needed in order to achieve the fixed cost hurdle or meet fixed costs. Here we have an example of a company that sells dog treats. The direct materials cost is $1.25. We can bake 8 boxes in 1 hour. The hourly rate is $15 per hour. The labor cost per box is $1.88. That's hourly rate divided by the 8 boxes in 1 hour. We estimate that the variable costs on a batch includes utilities and rubber gloves. That's 10 cents per package of biscuits, bringing the total variable cost per unit of $3.23. How we got that is the $1.25 of direct materials, plus $1.88 in direct labor, plus the 10 cents in overhead, variable factory overhead, to get to $3.23 per box. The fixed cost for insurance coverage, property taxes, and depreciation is $750 per month. Our initial price of a box of dog treats is $5, which includes a total of 15 biscuits. So, how many boxes would we need to sell in order to break even every month? We take the total fixed costs of $750 and we divide that by the contribution margin per unit. To find a contribution margin per unit, we take the sales price minus variable costs, which gets us, in this example, $5 minus $3.23 gets us to $1.77. $750 divided by $1.77 means we need to sell 423.73 boxes, or rounding up, 424 boxes. We also need to examine break even in terms of sales dollars. To do that, we take total fixed costs and we divide by the contribution margin ratio. In order to find the contribution margin ratio, we take the contribution margin per unit divided by the sales price per unit. So the aggregate tells us we need to find the total contribution margin divided by total sales to find the contribution margin ratio. This is, of course, going to be found as a decimal. So here are the types of questions we have. If it takes 424 boxes to break even, what is the demand for that many boxes of dog biscuits? Once we found the demand, what is the capacity for us to be able to produce 424 boxes? How long will it take us? Do we need to expand the operation? How many more boxes do we need to sell to earn a target profit? If we need to sell more than break even, what is the support for that in terms of capacity? And what other additional fixed costs would be incurred? Shall we reduce the variable cost per unit or increase the sales price? These are the kinds of questions we would ask ourselves when understanding the point of break even. What happens after we break even? Ultimately, the idea is we should be making a profit. This illustration shows us at the point of break even, our profit is zero because our total sales covers our total expense, which is the fixed and variable cost. Once we pass that point, we can begin to generate a profit. Here we can see graphically the point of break even and the point we begin to make a profit, where total revenue exceeds your total cost. Understanding cost volume profit analysis requires a couple of assumptions, such as the range and the margin of safety. The relationship between the company's revenues, costs, volume of sales, and of course, its profit needs to be taken into consideration. This allows the owners and managers to make decisions that ultimately impact the company's profit. By looking at the cost volume profit graph, we can see the point of break even and the point where we're making a profit, or the point where we're making a loss. Of course, we identify the total cost line and the variable cost line. When we see that the total cost and the variable costs have an intersect, then of course that tells us the number of units need to be sold in order to break even. The relevant range is the band of activity with a specific relationship between the level of activity and the cost being measured. Fixed costs, of course, always remain fixed. They do not change with the level of output. Variable costs are constant. The cost per unit is constant. In the short run, we can't make more than the space and the equipment will allow. However, there's opportunity for expansion in the future. This, of course, depends on the capacity. With a greater capacity, the more units we can produce. However, that would also mean that there will be a rise in fixed costs. The margin of safety tells us the time to calculate break even is before a venture starts, before we start production. Break-even point is used for predictive purposes. Of course, the point of break-even will change as costs change in the future. Break-even point should be lower than the number of units actually sold throughout the year. Margin of safety is the difference between the total units in terms of sales or sales dollars and the break-even point in terms of units or sales dollars. A firm will be profitable operating anywhere above the break-even point. Think of the margin of safety as being a margin of safety, number of units to be able to produce to be above the point of break-even. Here's the calculation in terms of units and sales dollars for margin of safety. Total number of units sold minus the break-even point in terms of units. That gives us the margin of safety in units. Sales dollars, total sales dollars minus break-even point in sales dollars. Margin of safety can be visualized here graphically with a bar graph. Above the break-even point is the margin of safety. Here we have the example. The break-even point is to sell 424 boxes of dog treats. Our fixed costs are $750. The contribution margin, as we know, is $1.77 per box. Sales price $5 minus total variable cost $3.23 gives us $1.77 contribution margin per unit. 750 divided by the 177 is 424 boxes. It's our point of break even in terms of units. If I sell 500 units minus the break even point, 424, my margin of safety is 76 units. Now, of course, we could look at that same type of calculation in sales dollars, and it would tell us the same thing. Now let's look at standard and modified break-even formulas, because as I mentioned earlier, costs change over time. So as the costs change, so must our break-even point. It needs to change with the changes in cost. So as fixed costs rise, so does the point of break-even. As variable costs rise, so does the point break-even. We can also determine our contribution margin based off of fixed and target profit. Target profit, of course, is the profit we desire to earn in the future based off of our number of units of sales. Target profit is the profit we want to achieve. To find the target profit, we take the total fixed cost plus the profit we desire to have in the future, divided by contribution margin per unit. This will tell us how many units we need to sell in order to achieve our target profit. To find it in sales dollars, we take the total fixed cost plus the target profit divided by the contribution margin ratio. And of course, we could find that same amount after tax by including the tax rate in the formula. 1 minus the tax rate, of course, target profit divided by 1 minus tax rate gives us the after-tax profit. We also call this the hurdle rate. Here we have an example. A company that sells dust mops. I like the name. Here we have variable costs are $35 per pair. The selling price is $55. The total fixed costs are $41,400. Let's calculate how many units we need to sell in order to earn a before tax profit of $28,000. So we take fixed costs $41,400 plus the target profit $28,000 divided by the contribution margin per unit, sales price minus variable costs, gives us the $3,470 units we must sell in order to generate a target profit of $28,000. We then rearrange that formula to tell us algebraically the number of units that we need to sell. Now, we wonder how many units would we need to sell in order to earn an after-tax profit of $28,000. The tax rate is 30%. So again, we take the fixed cost plus, and first we calculate it this way. We take the target profit, $28,000, divided by the tax rate, 1 minus 0.30, 30%. So 28,000 divided by 1 minus 0.3, which is 0.7. And then we add that to the fixed costs. Then we divide by the contribution margin. This tells us we need to sell 4,070 units to achieve a target profit of $28,000 after taxes. And of course, we could also solve that algebraically as well. What happens when the break-even changes, or we have multiple products in our product mix? Products of which the information sales price changes, there's a change in cost, and those are also tracked. When we have multiple products to consider, of course, we need to calculate the break-even on a per product basis, but also the product mix. And that collectively tells us the break-even based off of the sales mix ratio. The sales mix ratio is where the product is sold out of total sales. Here's an example of a sales mix. Here's what the company sells: popsicles, strawberry cones, and ice cream sandwiches. We sell the ice cream sandwiches make up the majority of the sales. Based off of that, we can calculate what's called the weighted average contribution margin for various products sold. This weighted average contribution margin is relative to the sales mix. And of course, takes into consideration the variable cost. So here's how the calculation works. We take the total fixed cost divided by the weighted average contribution margin. To find the weighted average contribution margin, we take the sales mix times the contribution margin, plus the sales mix times contribution margin, plus the sales mix times the contribution margin. We do that for all the products sold. And so in looking at the different types of products that we sell, we do that for each product sold. And then we, of course, add them up to find the average. Here it is graphically in Excel. Sales price minus contribution margin per unit. To get the contribution margin per unit. The sales mix by percentage gives us the weighted average per unit. Of course, we add those up to find the weighted average per unit. Once we found that weighted average per unit, we take fixed cost divided by the weighted average per unit to get 3,247 units total that we would need to sell to break even for the company that sells multiple products. So again, it's taken into consideration the sales mix and the number of units. And one of the last things we look at is called the sensitivity analysis. It's the answer what if questions. Sensitivity analysis, of course, is scenario based, and we use calculations to perform what would happen in potential situations. And this usually talks about the changes. What if our variable costs increase? What happens to the break-even point? Or what if our sales increase or decrease, or if there's a change in sales price, what happens to the break-even point? So here we have an example of water bottles that we sell for $6 each. The variable cost is $2 per unit. So our fixed costs are $30,000, and our monthly sales are 10,000 units. What happens when there's a 10% change? And looking at that 10% change, here it is before, here it is after. 10% times the increase in sales price, increase in variable cost, increase in contribution margin, minus the fixed cost, gives us our new operating income. And it's just a matter of factoring in the 10% change. What if there's a change in other costs? We would factor that in as well. Very similar manner. Understanding the operating leverage is another factor to consider. The operating leverage tells us how many fixed versus variable costs are in a firm's cost structure. And the way it works is it gives us what we call a degree of operating leverage. The degree of operating leverage is a multiplier that results in the change in sales and is used by this formula. We take the contribution margin and divide by operating income. It acts as a multiplier and is larger than the operating income. Variable costs are subtracted from the sales to arrive to the contribution margin. And of course, this is different from the fixed costs. Those are separated out. It's very difficult to operate without any fixed costs. So the degree of operating leverage is typically a whole number. And looking at the degree of operating leverage, we determine the fixed, the impact of the increase or decrease in sales. without having to redo the income statement. Of course, it also gives us an idea of the impact from operating income. In looking at the degree of operating leverage, we take the large contribution margin divided by the small contribution margin to give us a high degree of operating leverage. To achieve a high degree of operating leverage, we look at the contribution margin in terms of operating income. Having high fixed costs leaves a small operating income. Companies with high degrees of operating leverage experience greater profitability and gains in sales as they grow. However, the opposite is also true when it comes to losses. Calculating the degree of operating leverage looks like this. We take the original operating income times 1 plus the degree of operating leverage times the percent change in sales. This gives us a new operating income. Here we have an example for degree of operating leverage. Let's say there's a 10% increase in sales. What's the effect on the operating income? Company's contribution margin is $40,000, and the operating income is $10,000. Given this information and the change in 10% sales, we can identify the contribution margin, $50,000, and the fixed costs are unchanged. The company's expected 10% increase in sales. So plugging it into our formula, degree of operating leverage, contribution margin of 40,000 divided by the operating income, 10,000, gives us a degree of operating leverage of 4. Using that 4 degree of operating leverage, we plug it into our formula for the change. 4 times the 10% change plus 1 times the original operating income of 10,000 means that our new operating income will be 14,000. If the total fixed costs were to change, in this example going up, and all else in this situation remains unchanged, that will give us a new degree of operating leverage. Contribution margin divided by operating income gives us 2.5. 2.5 plugged into that formula reduces our new operating income to 12,500. With a change in the degree of operating leverage from 4 down to 2.5, our operating income grew by 40%. However, the sales only grew by 10%. The degree of operating leverage drops to 2.5, which means the income grew to 25%. All of this is relevant in proportion of sales. And lastly, one of the topics to cover is the cost-volume-profit analysis on a service company. A service company and nonprofit company can use cost-volume-profit analysis to optimize their results as well. It's typically based off of the level of output. So here we have a couple of examples. Consulting companies would use billable hours. Taxi or ride service share companies would use passenger miles. And in-home healthcare services uses services provided as their activity bases. And then looking at an example, here we have a rideshare company in San Diego. The company charges $1.85 per mile to all customers. The variable cost per mile is 55 cents. The fixed cost per mile, total fixed cost is $19,500 per year. The historical averages indicate that the employee drives 100 miles per day, 5 days per week, 50 weeks per year. Based off of this information, we take the revenue of $1.85 times X, which is the number of miles, minus variable cost of 55 cents times the number of miles, minus the fixed cost equals a break-even point of 0. This tells us revenue minus variable costs is $1.30 times the number of miles. We take the fixed cost divided by $1.30, giving us 15,000 miles to drive in order to break even. So based off of what you've learned today, it's important to understand the concepts of break even, because all businesses ultimately need to at least break even in order to survive. If you have any comments, questions, or concerns, please email me, contact me, or whatever it is that you need. I'm here for you 100% of the time. Thank you for joining me today. Have a great day.